So how do people like you and me bet on America? When it comes to investing, the good proxy of investing in the US market is to invest in the S&P 500 index. What is an S&P 500 index? The S&P 500 index is the 505 shares or symbols issued by the 500 large cap companies that are listed on the American Stock Exchange. Just in case you're wondering why the S&P 500 index comprises 505 shares or symbols in the entire index, the reason is because some companies issue Class A and Class B shares. For example, Google, there are two symbols, which is GOOG and GOOGL, which is a different class of shares issued by the same companies. The difference? One have a voting right, which is the GOOGL has the voting right, whereas GOOG has the one without voting right. The S&P 500 basically represents around 70 to 80% of the entire market capitalization of the American companies. Now, let's look at how much we can make by betting on America.
Alright, let's see what can we expect from investing in the S&P 500. What kind of return can we expect if we have a 3-year time horizon in investing in S&P 500? So this is the chart of S&P 500 since its inception in 1993. You can see the index always go up eventually. It goes up all the way, it comes down, it goes up again, it comes down, and it continues to go up right now until December 2019. So this is the daily historical price of S&P 500 up to December 31st, 2019. This chart alone does not include dividend. But nevertheless, let us have a look. If we invested, you can go to this website called moneychim.com/features/market_CAGR.htm. CAGR stands for cumulative average growth rate. So this is the growth rate that track analyzed. It's not like an annualized return. But let's say if you invested in S&P 500 3 years ago, how much annualized return would you expect? So I put in here 2017 to December 2019, which is a 3 years period. I click here, which is including dividends, and I press calculate. You can see here, if you invested in an S&P 500 ETF and you do not do anything at all, you would have grown your portfolio by 15%. This is the power of investing in an ETF. Just assume that you have a 5-year time frame. So I reverse another 2 more years. You would begin investing in 2015, and just do a calculation. Your annualized CAGR will be 11.62%, which is not too bad for a passive investment. Let's say you have a 10 years time frame, 2009, and you press a calculate here. You have a 10 years time frame. You press calculate here, your annualized return will be 14.68. Wow, that's amazing, right? For being a passive investor. But let's say you are very bad luck, right? You have a very bad luck. You invested at the top of the market, which means right here, you invest right here at 2007. Let's see how it goes. In 2007, had you invested your money in 2007, January 1st, 2007, until December 31st, 2019, you would have still get an annualized return of 8.78%, which is not too bad for a passive investment. Do nothing, just invest in ETF. In this case, S&P 500 ETF. For example, you are very, very unlucky. You invested at the top of the .com, right before the .com, right before the .com bust. You invest right at the top of the .com in 2000. Let's say in year 2000, you invest in year 2000 and include dividend. You calculate here, you can still get an annualized return of 6.01%. So you can see there is a range of, you can get a range of from 6% up to as high as 15% investing in ETF depending on your time frame. Of course, the key here is to have a longer time frame. The higher the time frame is, the less likely, the higher your returns. The more consistent you will get a positive returns. Of course, if you invest in 2000 and you sell off in 2002, you will have make a huge loss. So the key here is to have a long enough time frame. So hold the investment for long term. Another thing that is, this calculation is based on the fact that you invest all your money right at one point in time, which means you invest all your money in year 2000 itself. But that is not the approach that we recommend here. The approach that we recommend here, you invest based on a dollar cost averaging. What does it mean? So if you invest a portion of your money in year 2000, yes, you might only make annualized return of 6% of your money if you do nothing at all. But if you consistently invest over here, over here, over here, over here, over here, over here, and so on and so forth, continuously invest on a dollar cost averaging basis, your return will be way more than 6% return, annualized return. That is why we encourage a passive investment with a dollar cost averaging strategy in place. In that case, you are not timing the market, but you can still reap a huge reward just by investing in an ETF, in this case the S&P 500 ETF.
I hope you get something out of the video. If you are still heavily invested in fixed deposit, think again how you can maximize your return. If you think investing in shares or equities are risky, think again. Not investing in shares or equity is even riskier. There is nothing in investing that is certain, but one thing for sure, if you put your money and your hard-earned savings under the mattress, or you put it in a fixed deposit, I am sure 5 years from now it is worth even lesser. It is because of this thing called inflation. I hope this video will give you the confidence in investing by showing you the figures over the past years that can help you gain confidence in investing in equities. Because after all, what is risk? Risk is not knowing what you invest, but if you know exactly what you are investing and what you are facing in front of you, then it will give you the confidence, the faith, and the belief like what Warren Buffett has in investing. Please like this video and comment below and let me know your thoughts. I will see you in the next video. Thank you very much.